Joining us here at Post 9 this morning is Barclays Head of U.S. Equity Strategy, Venu Krishna. It's always good to have you in, Venu. Welcome.
Thank you.
What do you mean by material?
Well, so far we haven't seen the impact of tariffs. And if you recollect, compared to the beginning of the year, the reason we cut our numbers by roughly $10 for S&P is that we felt that tariffs are here to stay. What we're debating is the magnitude and what areas are impacted. And net-net, that we, in our view, has about a $10 impact. We haven't seen it yet, right? And the question is, I think it's quite likely that we'll start seeing some signs of that in this quarter. But recollect, I mean, just now you were discussing with the consumer, even in Q1 earnings, which are very strong, the one pocket of weakness we did see was in the consumer space, both discretionary and the staples space. And that was even without the pressure of tariffs coming in. And so I think this is the first time we may see. In fact, that is what is reflected in S&P sectors outside of tech. If you look at the numbers, they've come down quite hard. They're running worse than long-term averages. And the consensus for the first time expects that to contract, after about 4 quarters of expansion.
Right, but the magnitude of the tech part of the market is so large, it's going to drown that out, is it not?
Absolutely. So our view is that tech is once again going to bail out the whole market. If you remember, in the last quarter, the consensus expectation was around 14% growth for big tech. They posted 28%. This time, the expectation is roughly 15%. I think they'll blow past that number once again. The question again is, outside of that, we want to see which areas are managing the margins better, who and how is it showing up in terms of their ability to push prices through, and how is the consumer handling it. Those are something we will be paying attention to.
Did you get too bearish around the tariffs?
No. I think we haven't changed the numbers. I think what is important is that it hasn't shown up yet, right? And to the extent that even it shows up, the main thing is the market is forward-looking. We do expect earnings to rebound quite sharply next year, even in an environment where economic growth is going to moderate, but it's going to be better than this year. Consumption is going to improve, but worse than long-term pre-COVID averages. In such a universe, we expect earnings to actually rebound 9%, and consensus is actually a lot more stronger for next year. So I think it depends on, where you think we end this year and what happens next. In the short term, I think we have a range in terms of our base case and upside case, and the S&P is roughly in that range right now.
You would probably argue that, Morgan Stanley makes the point for you today that the margins are being supported by labor costs are benign, right? And productivity from AI can only get better.
Yeah.
Right? Those both make sense?
Yeah, they make sense, but just be careful that in the case of AI productivity, it is not yet showing up in the broader economy. It is showing up absolutely in the tech sector itself, especially from big tech, who are using it quite widely. And my guess is they're also laying off part of their employees because software productivity is up 30 to 40%. So if you're a tech-centric business or you're tech native, so to speak, then yeah, you're going to be able to handle margins very well. Outside of that, it's a question of how quickly do you adapt it and how quickly does it show up in your productivity numbers.
So just to be clear, I just want to understand you on the tariff stuff, because you said that it has yet to show up.
Yeah.
So you see it as a one-off impact?
Yeah, in the sense that after this year, we'll move past it and we'll just live with whatever the base level is. In our base case, when we cut our number down, we're expecting that it'll be roughly 30% on China and 10% rest of the world, which is quite.
And that will show up where most?
It will show up in the margins getting hit, especially for sectors outside of tech, especially in the discretionary, in the staples, in other.
But shouldn't investors just look through them if you think earnings are going to rebound sharply after?
Yeah, I do think they should look past it, because by the time we roll into next year, the key point is that we are past peak levels of tariff uncertainty. We are past the peak levels of geopolitical risk. So in such an environment, being forward-looking, having earnings rebound 9+% is actually quite healthy. And that's why in the short term, I'm not too sure you need to cut and leave the market. But you could selectively take profits. But you do want to have exposure to tech for sure, especially big tech.
When it comes to accelerated depreciation and pulling forward deductions and all the dereg from the policy backdrop, does that also drown out the tariff impact? Are tariffs noise?
No, very good point. I think they will eat. For example, if you look at the interest reduction, right? We went from 30% of EBIT to 30% of EBITDA. So obviously, if you're a highly levered company, or if interest expense is a big portion of your overall operating pre-tax income, then you will benefit. That's why, for example, even small caps are likely to benefit almost 9 to 10% in their earnings because of that change in feature, because they're highly levered. The other things to talk about, the ability to expense R&D expenses, the ability to accelerate depreciation, and this interest, I think as a combination, we are still evaluating it. But, I would expect that to be healthy. To some extent, it'll cushion the blow from tariffs. And tariffs also, mind you, our view is that only 50% is what is absorbed in their margins. 50% will be passed through in prices. And you saw this morning in the Wall Street Journal that Amazon, a whole bunch of numbers, they are going up, right? Our own analysts, when they did a field study recently in LA, looking at container ships, and so they actually saw that labels were being changed, up 30-40% for a lot of goods which are still out there in the storage facilities, right? So I think it is coming, but I think that as long as, to Sarah's earlier point, if you have consumer who's relatively strong, and that's been one of the key pillars of the U.S. economic growth story in the last 4 or 5 years, unemployment being relatively low, some moderation, I think we are in a respectable spot.
Venu, it's great to have you in. And we'll see what we get as we work our way through the quarter. Venu Krishna.
Okay. Thank you.